you miss anything here, I'm going to rebroadcast the video. Hopefully this will save. Last time it didn't, and I had to do a screen recording and posted it. And unfortunately, the video quality wasn't so great. But the truth of the matter is, with video, even when the video isn't so great, sound has to be key. If you have good sound, you're kind of okay. But if you have bad picture, it's not good. But if you have good sound with bad picture, it's a little bit better. So let's go through, let's get going. First and foremost, I'm Justin Pulitzer. A lot of you know me for years. Some of you are new to me. I've been a trader for over 25 years. I have a video service where I talk about trading and markets and trade setups. If you're interested in that, there's a link in my Twitter profile to sign up. So let's get into it first and foremost. Fed. So they're going to be reducing the balance sheet. They talked about a cap of $95 billion. They're going to phase in these caps, and they're going to be doing this over the next 3 months. They're going to be reducing $60 billion in treasuries, $35 billion in mortgage-backed securities, and I believe they want to fully blow out of the MBS. But I think that they're going to see how the runoff goes first. I had mentioned that in prior videos where I said it wouldn't make much sense to me for the Fed to sell their portfolio initially. Why not just let it bleed off and not do the reinvestment? And it seems like they took my advice for what it's worth there. For those of you, by the way, who don't think the Fed checks Twitter, they've openly admitted it. So, and I happen to know for a fact mine is one of their feeds that they do look into. So, if I can direct them in a way that I think is better, that's one that I will, take for the team. They did mention that will be market conditions permitted. So I guess they want to leave their outs open, their dodges, which is probably smart. I've been thinking the Fed is on the wrong side of a policy error for a while now. They started the taper early. They increased the taper after that, and then they went into rate hikes, and now it seems like from their Fed minutes that they not only want to do rate hikes, but they want to increase the rate hikes to 0.5 point, and they said the only reason they didn't do the 0.5 point in March was because of Ukraine. So I'm thinking to myself, do they now want to go 0.5 point? Are they going to take the shot, or Ukraine isn't resolved yet? If anything, it may be worse because of the supply chain and coming into summer wheat season, so maybe they'll hold off on the 0.5 point hikes and stick to the 1/4 point. But I'm telling you, I'm still of the opinion that they might pull the trigger on the 0.5 point the next go round. Should they? No. Will they? It seems like they may. They talked about this, at future meetings. They always put in that future meetings, like they kind of try to push it off. They will consider the sale of MBS after the runoff is well underway. So I don't know what that means, well underway. Does that mean with the Fed, that could mean the next meeting? They always say, in coming meetings, and then it's the next meeting. So maybe this means 2 meetings. Well, so, in future meetings means next meeting, and now well underway is maybe 2 meetings. So that's something I'm concerned about. They talked about the ample reserves framework. So this is something new and something I thought could happen, and I'm glad it did, that the Fed isn't going to reduce their balance sheet completely. Like all the stuff they did for the pandemic, they're not going to completely blow out of it. They're going to keep some on. So that is stealth QE, because if there is going to be runoff of runoff of the balance sheet, meaning securities they own are expiring, meaning 2-year treasuries, 5-year or whatever tranches they're in, and they're not going to go back to, let's just call it zero, year zero, meaning when it started for the pandemic. That means they're going to have to reinvest those securities. And that reinvestment is keeping the pool full. So what I think they're looking to do here is to gradually bring the water level down maybe, and maybe not even bring it down that much. And they're not going to drain the pool completely. So I think the market initially liked that, but then they were like, oh, wait, we're going to have to go through these 0.5 point rate hikes. And, it's sort of like over the river and through the woods to grandmother's house we go. Grandmother's house is where you get your cookies and your brownies, but you have to still evade the wicked wolf on the way there and try not to get eaten. So that's sort of what I'm thinking there. And I'm glad to, like I said, I'm glad again to hear the Fed is not going to completely drain the pool. What I would have liked to hear, and what I think where the puck is going to go when the economy starts going south, which we're already starting to see, in terms of GDP and so on and so forth, and I think employment is actually going to start taking a hit at some point as well. I think the Fed may have to be dynamic, where they may have to pause and maybe even start cutting again at some point. It seems to me that the Fed thinks that they're smart enough to engineer some kind of controlled recession, or like stall speed. It's sort of like trick pilots. I mean, the last time I checked, the Fed isn't the Thunderbirds up there, and they're not going to be able to do, the tricks and maneuvers with the economy that they think they're going to do. It's sort of like that line from not Captain Phillips, the other one with Tom Hanks, where he's Sully. He's like, we're not the Thunderbirds up there. It wasn't, just the routine, get the milk on the way home. So I don't think the Fed's going to be able to do it, and I think that they're going to wind up being very sorry that they, hit the brakes so hard. And now you've got some of the most dovish members, Lyle Brainerd, and a few of the others now talking tough about rate hikes. And I do think the Fed is likely going to do what they say they're going to do at this point. I mean, they've given us no reason to question them because, if anything, they've been stepping up the hawkishness. They haven't been walking it back. They've been stepping it up. And I think there was a lot of confusion from the last Fed meeting because of end-of-quarter markup. If you noted, the market initially took a header on the Fed both the minutes and the release, I should say the release. Today was the minutes, but the release and the press conference, and then it kind of went back up, and we had that huge run, but it wasn't because of the Fed. The market didn't like the Fed. They liked the end-of-quarter rally. They had to get through the Fed in order to get that rally up, and I think that's really was more of the reason for the rally and probably a cause for a lot of confusion. I don't think it's only confusion for traders, though. I think it's confusion for the Fed, and we saw that today with former Fed member, and I don't know how to describe him other than he's a bit of an activist, that guy Dudley, and he was saying, the Fed needs to, basically hurt the markets, and if the markets won't come down, on what the Fed says, they need to do more to do it. This was also the guy who was very anti-Trump and penned that op-ed that was very anti-President Trump. So he's a former Fed member, probably for good reason, and we don't have to pay that much attention to him. But I do pay attention to the likes of Williams and Brainerd and so on and so forth. And then we're going to have, Circus Boy Bullard out tomorrow talking super hawkish as well. So I would imagine that's probably going to reinforce the minutes. I'm sure Bullard's going to say he's ready for a half a point and maybe a full point, and he wants to start doing the taper harder and faster. And I mean, just talking tough. Is there anything? So I mentioned the Fed. So I'm keeping a couple of eyes on a few market indicators, and one of them is, of course, the Fed. And then I always talk about the Fed day range, but I think we could now adjust and use today's range particularly for SPY. And for the purposes of this video, we'll talk about SPY. I wish I could show you my screen. Maybe I'll post a screenshot after the video. I made my midweek video free this week because I do encourage everyone to watch it. I think that will save you lots of pain and potentially help maybe make some gains. Not so much, because I wanted to be super generous, but I wanted people to watch it, because I really do believe it'll help people. And when I help people, when I step out and do things like that, it saves me time on my DMs answering questions when that information is readily out there. And also, frankly, I really don't like to see followers and subscribers get beat up in the market. That's the reason you follow me, presumably, right? To have a little bit of a leg up and an edge. And if I can put that edge out there, it's great. So I do encourage people to see that video, and I'm not just talking my book here. The video is up for free, so please do watch it. But in regard to the day's range, SPY came back to a very key level today. It hit both the 20-day moving average, which was the breakout level. It had been the prior resistance, and it held the 50% fib of the entire, from the decline upward. So we're right on that level of the 50% fib, which is 445.31. So if you took a line measure from the January 4th peak to the February 24th low, the halfway point there would be 445.31. And not to be too simplistic, but the halfway line is really the demarcation that I follow to see who's in charge of the market. Above the 50% fib, the bulls are more in charge. Below, the bears are more in charge. And the fact that we had the check back there, to me, is key. We had actually gotten above the 61.8 of the market and then pulled back. And then we had that kind of head fake on Monday because of a few characteristics. I had listed them out in a tweet, and I'll just read them out to you here. I think sentiment had been very poor coming into the day. Many people had waited until Monday for Q2 allocations. We had seen a little Friday, but I think a lot of people wanted to just sidestep the weekend risk. And then Elon Musk's tweet, I think, about him buying into Twitter got the juices flowing about, where things could be going. And people bought up the market. And I also think the market is sniffing out a Ukraine situation where there might be a deal and the hostilities could end there at some point. We all know it's not going very well for the Russians. And I think that could be a cause for a pop in the market. And I do think that pop will be one to sell into, by the way. I had said to buy on the cannons and to sell on the trumpets. And we got the cannons. Remember, I was one of the only people at the time saying to buy, when the market was really tanking. I remember that day. It was really super ugly. And there was a little bit more ugliness after it. I'm sometimes right, like roughly around the right time. I might miss it by like a day or, even like a few ticks. But generally speaking, it's usually pretty spot on. And that turned out to be correct. And then I think the reason the markets now are pulling back here is that we had an end of quarter markup and people are taking those profits. A lot of people chased late and they're having their stops run. The Q2 allocations maybe have halted here. We saw some on Friday. We saw some on Monday. And I think just Brainerd's comments on Tuesday was like a slap across the face. We all knew the Fed was going to be hawkish, but now that you have someone who's been really, really dovish in recent history saying that, the Fed needs to now get hawkish, it was sort of like a wake-up call, that cold water being poured on the market. And then, of course, you didn't have Elon Musk tweeting that day. He'd have to have bought something else. It's sort of like in Batman, with Bruce Wayne, we have more hotels for you to buy, Bruce. I guess he didn't have more hotels to buy. You also have seen a free fall in the transports. If you want to see what I'm looking at in particular, take a look at the chart of J.B. Hunt, JBHT. I mean, that is a breathtaking chart. It had this big run-up, which often happens late in a cycle, and then like a complete collapse. Oddly enough, today had a bottoming tail hammer a little bit ahead of where I was looking for some support at 163.74. I think the reason that JB Hunt has been suffering also is prices are up on goods, and there is a little bit of a check back in terms of demand. And I think the cost of fuel has gone up and the cost of drivers had gone up, although I've heard that there's a demand-supply dynamic that's playing in there where that might be alleviating somewhat, which is really good news to hear. So I think that played a big part into it. And then, of course, there was the anticipation of the hawkish Fed today, and they did not disappoint. The statement was very, very hawkish. Will traders now look past that again and say, let's make money while the getting's good until the next Fed meeting? That's always possible. But we have a few things that are in our way. And they're things that I have talked about in prior videos. I talked about them in the midweek video, and I'm going to talk about them again right now. And those are, we're going into a seasonally bearish period calendar-wise because we have buyback blackouts. You also have companies that can't really comment because earnings are coming up. So you can see all kinds of articles, and I had given the example that we always see with the Nikkei Times where they come in and basically say iPhone demand is no good and no one's going to be buying iPhones, and then Apple usually gets crushed on that. But that's just one example. On April 12th, we're going to get an inflation read. The prior reads didn't really have a lot of Ukraine in it, and now we're going to be getting that in the oil data. So those inflation numbers are going to be super shitty. Sorry to, I just, there's no other way of saying it. They're not going to be good inflation reads. And I think the Fed is going to probably, if not even the Fed, maybe just TV reporters and financial journalists are going to be calling on the Fed to hike harder and faster. And we all now know that Brainerd is, on board with that. So presumably Powell will be as well. If we have April, is it April 15th or 17th this year, the tax day? They keep screwing around with it. But a lot of people sell stocks to raise money for taxes. And I think at this point also, a lot of people are like, okay, we've had a big rally off the lows. Let's see what earnings look like. So we're going to be going into earnings season. And if you recall, the last earnings season, market dynamics were awful. What do I mean by market dynamics? I've been talking about this again in a lot of my videos, but some people are new. It's just this, that when stocks reported good earnings, they had pops that faded very quickly, and then they'd give back all of the gains, and then maybe even then some too. And then when you had stocks that reported bad numbers, they crashed and then kept on crashing. So what's the true benefit there of stepping out and buying stocks ahead of earnings? One, you get a pop that's sort of muted, and if you're not quick enough with your options, you're pretty much screwed, or you get crashed and crushed. So I think we need to see the dynamics play out. I saw it already now with Nike, where it popped, it came back in. They tried to rally it again, but then it came down. And then Restoration Hardware was down, and now it seems to have bounced a bit. But we need to see it on some of the big stocks. I'd like to see it on FANG, and in particular on Netflix, because that's the first one to report. Recall, Netflix got creamed the last time, and Facebook too also. I expect, even if they're bad, the numbers, I don't expect those levels of plunges. It's very, very rare for big companies like that to have back-to-back dumps like that. I think they'll be within market maker expected moves this time around on those two. On the other ones, I can't speak, but I'm going on the line here saying I'm not saying the move is going to be up or down here yet. I want to see how the move plays out, but I do think they'll be within the market maker expected move on those particular ones. And if it does overshoot, it won't be by too much. The supply chain is only getting worse here. China is on day 26 of a lockdown. One of my friends, I was checking out her Instagram account. She posted, they're basically not even allowed out, and they put bags on their doors to get in-home COVID tests. And if the one person in the building, because they have a zero tolerance policy, if one single person in their building complex tests positive, the whole building goes on another 2-week lockdown on top of what they already had. And I just saw a video posted by a Chinese journalist, and it's from Shanghai, and it's drones flying out. If you're singing out your window, like a lot of people are trying to, I guess, keep their spirits up, they have drones with megaphones saying, please comply with COVID restrictions, control your soul's desire for freedom. Do not open the windows or sing. So that's a great example of communism, right? Control your soul's desire for freedom. Again, very scary, and something I unfortunately think will be in the United States at some point if we continue along this kind of woke path. But that's something to worry about. And then we don't have a resolution in Ukraine yet. So I'm looking for those things. I think the Ukraine opportunity, yeah, it is very scary. I'm watching the video now. I retweeted it on my video, and I have a few friends who live in China. I keep the ones who, my main one. I have one really main source. He works for a very, very large tech company, and he gives me, sometimes, he's the one who really gave me the heads up that COVID was going to be a big problem here. And he was telling me about the lockdowns and, basically told me get your N95 masks now while you still can. And I imparted that information on to you guys. I keep my for safety purposes, not even so much, for anonymity, but for safety purposes, that's a communist country and they could be in a lot of trouble. So I'm just going to keep it like that. So that's my I think we got a gauntlet to run here. I think we're back in a sell the rips type of move situation unless we can get above the recent highs. And let's say in SPY, I'm talking about I think if we got ourselves in SPY back up over like 457.83, I think that we could say safely the decline was over, because we had like a 4-day range, excuse me, after the recent high, and then today was a day one of the breakdown below that range. If we were to get over today's high tomorrow and get back into that range, I would view today's move as a look below and fail, and think we would come back up to the higher end of the range. But if price lingers inside of today's range and doesn't rally quickly and even goes below, then I think we're going to keep pulling back. I think we'd go immediately to the 50 MA, which is right below it, like 441-ish. And then, I don't mean to get anyone too scared, but we could come back down and maybe retest some of the lows. Potentially, I don't know if we need to go to the February low, but maybe the January low down closer to 420. So I think today's range is very key. Keep an eye on leading indicators like SMH, which is weaker than the overall market. That's never a good sign. I'm always most bullish on the tape when the SMH is stronger than the overall market, but like if you took a fib retracement of the entire move from the bottom to the rally, we tagged today just above the January 28th low and very close, not quite to the 78.6. And we did fill in that small gap, so that's running even weaker. If you, for comparison, I'm not going to do the lazy thing and compare it to SPY, because money managers always love to just do that. I'm going to do it to its benchmark. Let's do it to the Qs. The Qs are just at the 38.2. So if the Qs are only at the 38.2 and the SMH is at the 78.6, what does that tell you? Where is it going? It tells me that the Qs may have to play catch up to the downside. So either the SMH holds right here, right now, and rallies, or we're coming down lower. Now, I talked to you about the 50% mark on the SPY. Unfortunately, the Qs are also again weaker than SPY. We're right at the 38.2 of the entire move, and the 38.2 roughly of the rally. So we have a confluence there of 38.2s. The good news is that we're at a very key neckline here at 350.32-ish, and it's right roughly at the confluence of the 20 MA and the 50-day moving average. So if we are going to fail, it's going to be obvious. I mean, basically a move below today's low and below those levels, we're in dump mode again. And it could be like dump every day until, we reach the bottom. And I would think 338.22-ish, 338.19 would be a speed bump area, because that's the 78.6 of the rally. And it also lines up with the January lows. And then we'll see. That could form and I've shown you in videos, and you'll see if you watch the midweek video, that it could form an inverted head and shoulders bottom here. But the bad news is we may have to go lower to do that. Again, I think that the key today, or right now, is this Fed day. It's almost like a Fed day range again. The minutes have become like a second Fed day. So I use the Fed day as a gauge, and now I'm using the minutes days as gauges too. Anything above, I think, the the Wednesday high, today's high, I think is a move back higher to fill the gap above. Anything below, I think we're back in dumpster dive mode, racing toward that 338 level, basically in the Qs. Is there any other questions? Because I'm pretty much done with what I wanted to talk about. I see some of you being bumped in and out of the video. Are you guys losing connectivity or anything? If so, please always let me know that. But is there any other questions on the material we discussed, or anything you felt I missed that you want me to comment on? I can see the chat here if anyone types anything. It's sort of like the old Periscope. Nothing? Really? Guys are very quiet today. Very quiet. I don't know what's going on. Did I put you to sleep? Was I that boring? I feel like I bored everybody here. Or was it just that thorough that there's no one needs to comment? Okay, so would you get long over 45.20? You're talking about in ES, I'm assuming. So I think the key in ES here is like 45.01 quarter. That was the breakdown from the range low. I think that area could be some resistance, and in the Qs that's 14.725. So those are the key levels if you want to jot them down. If we got over those, I would think we kind of neutralize, so neutral to higher. but below those levels, both 45.01 quarter in ES and 14.725 in the Qs, it's weak. Someone asked me about Tesla. Look, Tesla ran super hard, super fast. We know they have the split coming. It's pulling back. I think it could still pull back and fill the gap maybe to 10.1064-ish. The 78.6 there to me was an obvious sale. Today we roughly held the 61.8, so if you're long, I would use today's low as a stop. And if you want to short, you could use today's low as an entry with the close as a stop. Makes sense to me. And then I'd be looking for it to dump maybe down to like the 20 MA. And then I'd cover and then we'd see. You know, it's sort of like F around and see. So then we'd see. The 20 MA would be the row long spot. If that failed, then we're talking about 50 MA, 200 MA. The 200 MA, 50 MA zone, I would be very into buying the dip. The same in Amazon, by the way. 50 MA is my re-entry area. Anyone else with any questions before we wrap up here? Damn, I'm getting that good. Amazon, what are you thinking taking a long... I just answered that one. I think 50 MA, I'd be long Amazon down there. Is Google 27.15 a hard stop? Let's take a look. Google. I mean, today bounced off the 50 MA. I think you could just use low of day today and Google as a stop. I mean, the channel low is a little bit lower, but if you want to be long against basically low of day today, that makes sense. I'd add to Google above today's high, but if it gets below and stays below the 50 MA, yeah, I mean, I think you got to be out, at least for the short term being. Alibaba. Let's take a quick look at the Baba. So as far as Chinese stocks go, I mean, the big fear, again, with China is that it's going to be like a situation with RSX, where if they go into Taiwan, that these things will be shut down and you'll be, basically your money will be locked up. I think that China has shown that they're trying to be a little bit more market friendly with complying with the SEC and so on and so forth. And my timeline for a Chinese Taiwan invasion is after November, because Xi is up for re-election, and I think after he saw how crappy things went for Putin, I don't think he wants to risk it. I know everyone, Xi is dictator for life and what have you, supposedly, but he's really not. There's actually other factions who are out of power who have been hurt by Xi, and I think that he would, I think he might have been inclined to do it before as like a victory, but I'm thinking afterward is my thinking. So with regard to Baba, just use the 20 MA if you want to use low of day as a stop. I don't know that I'd give it all the way down to $100. Today was sort of like a mini range breakdown, so if you want to buy it over high of day, that makes sense. It's really got to clear the 100 MA though to get going. Yeah, how do you like that Avago play? I saw that question on Avago. The low of day was almost perfect touch of the 50 MA and the trend line and the 50% fib. The bounce level was perfect up to the 20 MA, and then it kind of dumped again. Is it late to do the trade? Is it too late? Well, it's certainly not early. I think that trade kind of played out today perfectly, and I think it's going to depend on the market now. If you want to be long and try Avago, just use a low of day as a stop, because it's right on trend, it's right on the 50% fib, it's right on the 50-day moving average. So it's a do or die spot. I mean, if it loses that, the thing could keep dumping and maybe even fill up the pennant all the way down to 564.75. I don't think you want to be long if, and maybe down there I'd try it again, but I'd more be into buying the 200 MA if we keep dumping in Avago, but for right now, right here, right now, I'm cool being long against the Wednesday low, which was currently 593.77. That was a honey of a bounce, though. I mean, it was right to the 20 MA, which was perfect. It stalled there, though, which has me a little bit concerned. So we got the one trade. I would do it now if you didn't get it already. Smaller size, half to a third size. Any more? Let me see. Did I miss any questions? I think that's about it. I hope my video was informative. If you have any comments or suggestions for future videos, let me know. I'm sort of enjoying doing these again. They're a little fun. You get to see my mug, which is decidedly looking a lot older than it did when I used to do these videos. Anyway, have a great rest of your week. Please check out the midweek video. I put it up for free. It's there to save you guys from making very bad mistakes and hopefully to make some money. Have a great rest of your week. I will be doing my midweek video next week, as I believe also on Tuesday, and then the weekend video will be obviously late night Friday, early Saturday. I think you could, if you came into this late or want to rewatch it, I'm going to hopefully have better luck saving it this time, and then I'll repost it to both my Vimeo and YouTube channel. I'm starting to use YouTube again a little bit. Cheers. If I could figure out how to end it, that would be very helpful too. I don't think that I even can figure out how to end it. Oh, here we go. Stop.